Welcome back to the Daily Crypto Roundup. If you're listening right now, take 2 seconds. Hit follow and drop a 5-star rating. It helps the algorithm more than you think and keeps independent crypto coverage alive. Today we're coming off one of the most chaotic fortnights of the year. A $19 billion liquidation event that shook the market, traders trying to rebuild positioning, and policymakers on both sides of the Atlantic drawing new battle lines for the next phase of crypto regulation. But amid the noise, 4 stories actually matter. First, Britain's top regulator has formally backed tokenized investment funds, a decision that could reshape how ordinary investors access traditional markets. Second, the fallout from last week's Hyperliquid meltdown still echoes across leverage desks. Third, Citigroup has announced its official timeline for rolling out crypto custody. Yes, a major Wall Street bank finally offering to hold Bitcoin and Ethereum. And fourth, we'll close on a pre-sale called Ozak AI, a mix of hype and technology that's caught fire on crypto Twitter. But before we dive into the headlines, let's talk numbers. Bitcoin is trading at roughly $112,700, down about 2% from yesterday's close. That's a far cry from last week's panic lows around 108K, but we're not out of the woods. Volatility remains elevated, and funding rates on perpetuals are hovering just below neutral. A sign leverage is still being rebuilt, slowly. ETH sits near $4,120, steady within a 4K to 4.3K corridor. It's still digesting that macro whiplash from US-China tariff talk, but transaction fees on L2s like Arbitrum and Base are back to pre-crash levels. A quiet sign network activity never really died. BNB is around 1,228, Solana near 205, XRP roughly $2.50, Cardano 70 cents, Dogecoin 20 cents, Tron 31 cents, Chainlink $19, and Avalanche just under 23. The tape looks calmer than last Friday's bloodbath. We're back to a normal rhythm. Spot buyers probing support, derivatives traders hedging sideways. This morning, Reuters confirmed that the Financial Conduct Authority, the UK's main financial watchdog, has officially endorsed the creation of tokenized investment funds. That means traditional funds, like equity or bond portfolios, could soon issue their shares directly on public blockchains, such as Ethereum. This isn't a pilot buried in a press release. It's the regulator saying, let's modernize the plumbing. Imagine your pension fund or savings account owning shares that exist as on-chain tokens. Settlement could happen in minutes instead of days. Transfers could be peer-to-peer, audited transparently and fractional, letting smaller investors hold slices of portfolios that used to require £10,000 minimums. It's not just speed, it's access. The FCA's memo specifically mentions broadening investor participation and improving efficiency. In plain English, the UK wants to stop losing young investors to offshore exchanges. Back in 2021, analysts at Franklin Templeton and Citi predicted that tokenization would underpin all securities markets within a decade. People laughed. Now the City of London is quietly saying they were right. Of course, there are hurdles. Custody of on-chain fund shares still raises compliance questions. Transfer restrictions must obey KYC and anti-money laundering rules. And tax treatment, capital gains versus income, will need legislative tweaks. But the shift is already underway. The FCA has set up a digital securities sandbox with the Bank of England to test tokenized issuances on public infrastructure. Industry consultation runs through early 2026, but the direction of travel is clear. Let's be honest. This isn't about chasing hype. It's about fixing inefficiency. Ask anyone who's worked in traditional fund settlement. It's still paper and phone calls. Tokenization cuts that friction. Market reaction today was muted. These are slow-burn catalysts. But long-term, this is the kind of foundation that lets crypto blend into mainstream finance without anyone even noticing. One analyst called it the quietest revolution you'll never see. When regulators get comfortable using public chains, that's when the big money arrives. Now, let's talk about the bloodbath and what it really did to the market's foundation. Over the last week, the largest liquidation event in crypto history erased roughly $19 billion in open interest across major exchanges. On one platform alone, Hyperliquid, more than 6,300 wallets went under, vaporizing about 1.23 billion in trader capital. For anyone new to that name, Hyperliquid is a derivatives exchange popular with power users. It advertises deep liquidity and ultra-tight spreads, but the fine print always mattered. It's still a high-leverage environment. What triggered it wasn't a flash crash glitch, but a human one. Panic on the back of US and China trade tension. When the US president hinted at expanding tariffs and China retaliated with its own restrictions, macro traders dumped risk and leverage. Heavy crypto traders learned the lesson instantly. When macro sneezes, you catch pneumonia. Leverage evaporated in hours. Accounts auto-liquidated. Funding rates snapped from plus 0.03 to minus 0.04 in less than a day. That's what makes these events brutal. They're not about a single whale selling. They're about cascading margin calls. When one layer triggers, the next 10 follow. But there's a hidden positive. These events act like a system reset. Overheated positions are flushed out, funding reverts to normal, and the market becomes less fragile. It's painful, but necessary, bleeding off pressure before the boiler explodes. Several analysts made this point today. One derivatives desk lead told CoinDesk, "We had to let the air out of the balloon. Now the market can breathe again." Matrixport's research team echoed that sentiment, calling the weekend washout a structural cleansing, not a terminal break. That distinction matters. A wipeout doesn't mean confidence is gone. It means the easy money's gone. Look back at previous cycles, 2017, 2021, even the FTX aftermath. Each of those had a moment where leverage drowned itself, and each time the survivors built the next leg higher. Right now, if you look beneath the noise, you can see that same quiet rebuilding. Stablecoin inflows on exchanges are up 2% since Monday. Spot volume on Coinbase and Binance has stabilized. And while traders are licking their wounds, the long-only crowd, the people dollar-cost averaging into Bitcoin and ETH every week, hasn't flinched. That's how recoveries start, not with fireworks, but with quiet conviction. Before we move on, a practical reminder. Events like this highlight the importance of self-custody. Exchanges freeze, APIs fail. Liquidation engines don't care about your circumstances. If you hold any meaningful stack, get it off centralized platforms. Use a hardware wallet, but hold your own keys. There's a Ledger affiliate link in the episode notes if you want to protect yourself properly. Now, climbing from chaos to structure, Citigroup confirmed plans to launch full crypto asset custody services in 2026. To anyone who's followed this space since the early days, that's remarkable. This is the same bank that once called Bitcoin a speculative sideshow. Now, it's building regulated vaults for digital assets. Citi's move comes after years of internal research and pilot projects. It will allow institutional clients, asset managers, hedge funds, and corporate treasuries to store Bitcoin, Ethereum, and tokenized securities using the same compliance standards as traditional assets. One senior executive told CNBC, "Client demand is real. We're now confident the infrastructure is mature enough to do this safely." Those words matter more than any meme or tweet, because that's how old money institutions talk when they're about to commit billions. Citi's global custody division manages more than $20 trillion in assets. Even if a fraction of that gains digital exposure, that's huge inflow potential. It also signals that compliance, not hype, is now the gatekeeper for adoption. This isn't about retail mania, it's about back-office integration. By 2026, when you open an account at a major brokerage or bank, the option to hold a Bitcoin ETF or even direct tokens might sit beside your traditional fund holdings. Citi's move follows similar decisions by BNY Mellon and JP Morgan, both of which have already run pilot programs for tokenized settlement and custody. Traditional finance is embracing blockchain quietly, while retail traders lick wounds. And that's exactly how long-term bull markets rebuild. Infrastructure leads, speculation follows. And don't underestimate the optics. When one of the oldest, most conservative banks in the world steps into digital asset custody, It gives CFOs and institutional boards the comfort they've been waiting for. It turns the question from "is crypto safe?" to "which custodian do we use?" Back in 2021, Citi's analysts predicted that tokenization of real-world assets could reach $5 to $10 trillion by 2030. At the time, it felt lofty. But look where we are. The FCA in London just greenlit tokenized funds. Hong Kong has its own pilot bond program on blockchain. And even the European Investment Bank is issuing debt on Ethereum. The thesis aged well. In the background, institutional rails are forming while retail noise fades, and that's bullish. Reuters didn't headline this as Citi jumps on the crypto bandwagon. They wrote, "Citi to offer digital asset custody in 2026. Matter of fact, professional. That's when you know a technology has crossed over from story to sector. Expect a trickle of follow-ups from other global banks. Standard Chartered, HSBC, maybe even UBS. They won't want to be left out once a peer legitimizes the space. Remember, custody is the foundation for everything else. Once secure storage is solved, trading, lending, and tokenized issuance scale exponentially. As one analyst told CoinDesk, when custody goes corporate, capital follows. Exactly right. We've talked regulation and we've talked infrastructure, so now let's swing to the other end of the spectrum, the retail frontier, where imagination meets speculation. The token making the loudest noise this week is Ozak AI. It's in the middle of a hyped pre-sale priced near 1.2 cents, with the tagline, "Powering Intelligence Through Decentralization." The project claims each token will represent a fraction of compute capacity inside a distributed AI training network. Basically a decentralized version of renting GPUs. Instead of paying a centralized cloud provider like Amazon AWS or Google Cloud, developers could source compute from a network of community nodes, paying in Ozak tokens. It sounds familiar because others have tried. Render Network, Fetch AI, Singularity Net. But timing matters. In 2025, AI compute shortages are real. NVIDIA's chips are booked out for months. Hedge funds and universities are scrambling for capacity. Ozak's white paper leans into that. Artificial intelligence cannot be free if compute remains centralized. The pre-sale structure is aggressive. 12 phases, escalating price, heavy referral incentives, classic crypto theater, urgency, scarcity, community hype. But underneath, there's at least an attempt at substance. Their testnet uses a modified proof-of-use algorithm that tracks actual compute utilization, improving on earlier AI tokens that were mostly slogans. Will it last? No one knows. Many pre-sales fade once they list and early buyers take profits. But dismissing every experiment risks missing innovation. Analysts at Cointelegraph called Ozak AI a speculative mirror of genuine demand. Hype that still points to a real problem. The takeaway isn't to buy it, but to watch how people react. Retail appetite tells you when the market's emotional pulse returns. These little bursts of mania are early signs of confidence creeping back. While retail chases AI dreams, the US government reminded everyone it's still one of the biggest whales in crypto. Late Monday night, blockchain tracking firm Arkham Intelligence spotted a transfer of 667 Bitcoin from a wallet linked to the Department of Justice. The coins appear to be part of prior seizure reserves, possibly from Silk Road recoveries. Immediately, traders went on alert. Historically, these government wallet movements sometimes precede auctions. Remember the 2023 sale of Silk Road assets that briefly spooked the market? Same dynamic. This time, analysts were split. Some think it's just a custody reshuffle. Others suspect preparation for another structured sale through a US Marshals auction later this quarter. Here's the key. Nothing has hit exchange clusters. No deposits to Coinbase or Kraken. The coins are still cold. And that matters because on-chain transparency lets us separate fear from flow. A move isn't a sale until those coins migrate to an exchange hot wallet. Still, these events shake trader psychology. Government wallets act like shadow whales. They rarely move, but when they do, the ripples carry. One Arkham analyst joked on X, "Whenever the feds move coins, traders hold their breath." It's true. Every official wallet movement becomes a moment of collective tension. From a macro perspective, this shows how deeply intertwined Bitcoin is with institutions. Not just corporations and funds, but governments themselves. State treasuries now hold billions in seized or tax-recovered assets, which means part of the long-term supply overhang is public, not private. But there's another way to see it. Governments selling crypto is part of normalization. The same way they auction gold, they'll auction Bitcoin. In a strange way, that's bullish. Proof digital assets are now standard financial property. So don't panic on every wallet ping. Watch for confirmed exchange deposits, not just address reshuffles. Crypto isn't going anywhere. It's evolving, brick by brick, code by code, wallet by wallet. This has been your Daily Crypto Roundup. We'll be back tomorrow, and as always, we'll see you at the top.